Welcome back to the Pro Ticker Podcast, everyone. This is your Monday morning edition, covering major financial magazine headlines. It's been a wild week in finance, huh? Tech stocks, just all over the place. Warren Buffett, doing his thing, making some moves. Global markets, I don't know, still trying to figure out this new Trump administration. What are they doing? What are their policies? So we're going to dive in today, see what's happening, try to learn a little something. We've got some really great sources today. We're pulling from the Wall Street Journal. We got Bloomberg, MarketWatch, all the good stuff. So yeah, we'll piece it all together for you.
Yeah, I think it really feels like we're in this time when every decision has these huge implications, from government policies to what individual companies are doing. And in a way, it all kind of flows down into your portfolio one way or another.
Absolutely. Absolutely. And speaking of big decisions, let's start with Intel. So the Wall Street Journal is reporting that Broadcom and Taiwan Semiconductor Manufacturing, TSMC, they're both eyeing pieces of Intel, which could potentially lead to them breaking up this iconic chip maker.
It's a pretty dramatic shift, I think, for a company that was at one point the undisputed king of chips. But I think as the Wall Street Journal's pointing out, they have been stumbling lately. Their market value's taken a hit, and they've really fallen behind TSMC and Samsung when it comes to making the most advanced chips.
Yeah, that definitely puts things in perspective. So what does this potential breakup tell us about the overall chip industry then?
I think it's a sign of a bigger trend towards specialization. Yeah, and not just in chips either. I mean, you think about it, Intel used to do it all, right? They designed the chips, they manufactured them, and they dominated, for decades. But now you've got companies like Broadcom that are just laser focused on the design aspect, while TSMC has just become the go-to manufacturer for basically everybody, even some of Intel's rivals.
Makes sense. So, okay, how would this break up? How would this actually work then? The Wall Street Journal lays out a couple of scenarios.
Right. So I think the most likely scenario is that Broadcom would take over, the design marketing side of Intel, while TSMC gets the manufacturing plants.
Okay, and so this is where it gets a little tricky, right? Because TSMC, they're a Taiwanese company, and chip manufacturing. That's a pretty sensitive area, especially when you start talking about national security and things like that.
Yeah, absolutely. And I think any deal involving TSMC would almost certainly need approval from the U.S. government, which could complicate things. I mean, who knows how long that could take and what kind of concessions they might ask for.
Yeah, it'll definitely be interesting to see how that all plays out. So meanwhile, Intel's stock had its best week in 25 years, which is pretty crazy, breaking a year-long downward trend. And that's according to MarketWatch, by the way. So is this a sign that Intel is back on track, or is this just a temporary bump?
Well, MarketWatch has some good charts in their article that really help break this down. The stock did manage to push through a long-term resistance level around $25, which is a big deal, but there's still this gap to fill from a drop. That's happened back in August of 24. The fact that it's above its 200-day moving average, that's a good sign, but I think it's still too early to say for sure if this is a true turnaround or not.
Yeah, I think that makes sense. I mean, you got a company potentially being broken up, stock prices all over the place. I mean, it really just highlights how fast things move these days, especially in tech and finance, which brings us to another big trend that Bloomberg's calling out: the explosive growth of derivatives trading. They even say that derivatives trading swallowed the entire market, which is a pretty bold statement.
Yeah, it's almost like the Robinhood boom and, the rise of meme stocks, but with derivatives this time, we're seeing everybody from individual investors who big institutions getting into options, swaps, all these other leveraged positions.
Okay, so for those of us who aren't Wall Street wizards, could you break down what derivatives actually are and why this trend is so important?
Yeah, so basically derivatives are financial instruments that get their value from something else, like an underlying asset. Could be a stock, it could be a commodity, and they let investors kind of bet on price movements without actually owning the asset itself.
Oh, okay. So potentially huge gains, but also huge losses. I mean, Bloomberg really emphasizes how this is changing the entire market landscape.
Oh yeah, absolutely. I mean, the sheer volume of derivatives trading now, it's so massive that it can actually like magnify these market swings. So even a small move in the underlying asset can translate into like giant wins or losses for people holding these derivative positions.
Gotcha, gotcha. And Bloomberg also has a pretty strong warning in there about, blindly following social media influencers who are promising like guaranteed returns from options trading, which always makes me a little nervous.
Yeah, it's a great point. I mean, derivatives they're complex, and jumping in without really understanding the risks can lead to some serious financial pain. This is not a game for amateurs.
Yeah, good reminder for everybody out there. Now, let's kind of shift gears a bit and look at the global picture. So you've got Indonesia introducing new rules for exporters. And then there's talk of oil exports resuming from Kurdistan. I mean, it feels like there's always something brewing around the world that could impact your portfolio.
Yeah, and what's interesting to me is how these stories kind of reflect larger economic trends. So, for example, according to Bloomberg, Indonesia is trying to strengthen its currency, the rupiah, and build up its central bank reserves. And then you've got the potential return of Kurdistan oil exports, which Bloomberg also reported on. And that just throws like a wrench into global supply and OPEC Plus's attempts to manage oil production.
Right, right. And we can't forget about President Trump calling for OPEC to lower oil prices. I mean, is that tied into all of this?
Oh, absolutely. I mean, Bloomberg is also reporting that OPEC Plus might delay a planned supply increase in April, even with the pressure from Trump.
It's like a giant game of chess with all these different pieces moving at once.
It really is. And understanding how all of these events are connected is crucial for investors who are trying to, make sense of the market.
Absolutely, absolutely. Okay, let's bring it back home for a moment. MarketWatch has a story about Warren Buffett making some surprising moves in the fourth quarter. So he bought stakes in Constellation Brands. They own Beer and Wine, Domino's Pizza, and Pool Corp. But then he sold off his position in Ulta Beauty. It's kind of an interesting mix there.
Yeah, it definitely raises some questions. What does this tell us about his outlook on like consumer spending, economic trends, or maybe even a shift in his overall investment strategy?
Yeah, maybe he's just really into pizza and beer these days.
Hey, maybe that's it. But MarketWatch also mentions that Buffett's annual letter to Berkshire Hathaway shareholders is coming out soon, and everyone will be watching the company's cash position very closely.
Speaking of watching things closely, the S&P 500 has been surprisingly resilient despite all the crazy headlines. But MarketWatch says some analysts are starting to get nervous. They're worried about more volatility with all the uncertainty
around Trump's trade policies.
It's a real tug of war right now between the bulls and the bears. MarketWatch also quotes some analysts who are staying optimistic. They're pointing to strong fundamentals and continued economic growth in the U.S.
Right. But then you have to consider the economic data, right? So CNBC is reporting that retail sales took a hit in January, which could be a sign of slowing growth. And then there's the spike in unemployment claims in Washington, D.C.
Yeah, that retail sales slump is a bit concerning. But CNBC points out that the unemployment jump in D.C. is probably tied to Trump's efforts to shrink the government. Okay, so much to consider. What is the key takeaways then for investors trying to make sense of all this?
I think the bottom line is that we're in a period of major uncertainty with a lot of different factors at play.
Yeah, and that's what makes it so fascinating, right?
Exactly. And that's why we do what we do, to help you connect the dots and understand the forces that are shaping the financial world.
Absolutely.
Yeah, it's definitely a time for both caution and opportunity. Staying informed, diversifying your portfolio, and having a clear investment strategy they're more important than ever.
So true, so true. Speaking of staying informed, there's a story in the Wall Street Journal that caught my eye. It's about Unicoin, this crypto firm that's claiming to have created the next Bitcoin, but they're facing a potential lawsuit from the SEC for fraud.
Yeah, I think this case really highlights, the ongoing battle between the crypto world and regulators. Unicoin is saying they've followed all the rules and that their token is backed by, real assets like real estate and mining rights.
They even threw like this huge yacht party in New York City to promote their token. They called it the only show that can make you rich.
Bold move, bold move. But as the Wall Street Journal points out, some crypto experts they aren't buying it. They're seeing red flags in Union's marketing and how they structured the deals for these so-called assets.
Right, right. And this is where I think the change in administration gets really interesting. Remember, President Trump's election, it fueled this rally in Bitcoin. And his pick to head the SEC, Paul Atkins, he's seen as much more crypto-friendly than his predecessor.
That's right. And the Wall Street Journal, they quote Unicoin's CEO, Alex Kononenko, saying, he's optimistic about this radical change in policy.
So does this mean like the SEC is going to ease up on crypto under Trump, or are they going to keep cracking down on what they see as scams?
It's hard to say for sure, but this case will definitely be a test of how the new SEC approaches crypto regulation.
For sure. Speaking of tests, President Trump has also said he wants to bring down Treasury yields. The Wall Street Journal outlines a few ways he might try to do this, like cutting spending, increasing energy production, and maybe even changing the types of debt issued by the Treasury.
Yeah, I mean those are some pretty big goals, and there are definitely hurdles. I mean, bond investors have always seen Trump's policies as likely to increase the deficit, not reduce it. And while boosting energy production could help with inflation, it's not clear if U.S. whackers can really ramp up supply that much.
Right. So will Trump succeed? And what does all this mean for investors?
I mean, those are the million-dollar questions. If yields do go down, it could make stocks more appealing compared to bonds. But if Trump's policies lead to higher inflation, that could eat away at the value of your investments.
It feels like everything is connected. Higher yields, lower yields, inflation, crypto, oil. It's enough to make your head spin.
It really is. That's why it's so important to have a framework for understanding these complex relationships. And that's what we try to do here on the Deep Dive. To help you connect the dots and make sense of the forces shaping the financial world.
Absolutely. Now, there's another global headline from Bloomberg that I think we need to talk about. The UK government is thinking about like a radical shift away from longer-term debt to try and manage its growing borrowing costs.
This is a big deal, and it reflects something we're seeing in other countries too. As interest rates climb, governments are facing more and more pressure to shrink their debt burdens.
Right. So how would this shift? How would this actually work?
So Bloomberg explains that the UK's debt management office would basically reduce the amount of long maturity bonds it sells to investors and focus more on shorter term debt.
Okay. And what would be the impact of that?
Well, it could potentially lower the government's borrowing costs in the short term, but it also increases refinancing risk because the government would need to roll over more debt in the coming years, possibly at higher rates.
Oh, I see. And this brings up another interesting question. Could we see the U.S. making a similar move?
It's definitely possible. The U.S., has its own debt problems, and rising interest rates are making them even worse.
Yeah, for sure. This has been such a dense deep dive already. It feels like we're just scratching the surface of some of these topics.
Yeah, we've covered a lot of ground today, but there's always more to explore in the world of finance.
Speaking of exploring more, are there any other stories that stand out to you from this past week?
One that I think is worth mentioning is YouTube's growing dominance in the media landscape. MarketWatch has an article that really highlights how the platform has become, a powerhouse, not just for video streaming, but also for live TV, music, and even podcasts.
It's amazing to think, how YouTube has evolved from its early days of like cat videos and amateur musicians to become this massive media giant.
It really shows the power of user-generated content and YouTube's ability to adapt to changing consumer habits. MarketWatch points out that YouTube's ad revenue is almost as big as Netflix's total revenue and double that of Spotify.
Wow, that's incredible.
Yeah, and YouTube's CEO is even saying they've overtaken traditional TV.
Wow.
It's a bold claim, but the data seems to back it up. Nielsen reports that YouTube was the most streamed platform on television in December, beating out Netflix, Amazon Prime Video, and everyone else.
Wow. So what does this all mean? Is YouTube unstoppable?
It's certainly a force to be reckoned with, and its success really highlights the disruption happening in the media industry as more and more people turn to streaming platforms for their entertainment.
Yeah, it's fascinating how these trends are reshaping the entire media landscape. And it makes you wonder what the future holds for traditional media companies.
They're definitely facing some serious challenges, but as we've seen, time and time again, innovation and adaptation are key to survival in the world of business.
It seems like we've covered just about every corner of the financial world today, from chips to derivatives to global economic trends to the future of media.
It's been a whirlwind of information, but hopefully we've helped you make sense of it all and given you some food for thought.
I know I've learned a lot from this deep dive, and it's a great reminder that staying informed is essential for anyone who wants to navigate the complexities of the financial world.
Exactly. And that's why we do what we do, to provide you with the insights and analysis you need to make informed decisions.
Yeah, it really is amazing how quickly things change in finance and media. It seems like every week there's just like a new set of challenges and opportunities.
Oh, for sure. And that's why it's so important to stay ahead of the curve, to be, constantly learning and adapting to these new realities of the market.
Speaking of new realities, MarketWatch has this article about President Trump's push to bring down Treasury yields. It seems like he's trying everything he can to keep interest rates low.
He's definitely been vocal about it, and the Wall Street Journal actually outlines some of the tactics he's considering, like cutting government spending, boosting energy production, and even potentially changing how the Treasury issues debt.
I mean, those are some pretty drastic measures. Do you think they'll actually work?
It's tough to say. Bond investors have historically seen Trump's policies as inflationary, which would typically push yields higher. But if he's able to convince the market that he's serious about fiscal responsibility, it's possible he could have some success in bringing those yields down.
And how would lower yields affect the average investor?
Well, if yields go down, it could make stocks, relatively more attractive compared to bonds. But it's important to remember that lower yields can also be a sign of a weakening economy. So it's a bit of a double-edged sword.
Right, right. There always seems to be that trade-off in finance. You take on more risk for the potential of higher returns, but then you have to worry about things like inflation and economic downturns.
Yeah, that's the nature of the game, and that's why diversification and risk management are so crucial. You don't want to put all your eggs in one basket, especially in times of uncertainty.
This has been an incredible deep dive today. I mean, we've covered so much ground from Intel's potential breakup to the rise of derivatives trading to President Trump's efforts to reshape the economic landscape.
Yeah, it's been a whirlwind of information, but hopefully we've provided you with some valuable insights and helped you connect the dots between these, seemingly disparate events.
I always feel like I walk away from these conversations with a much clearer understanding of what's happening in the world and why it matters to me as an investor.
Well, that's what we aim for, to empower you with the knowledge and tools you need to navigate the complexities of the financial world.
Well, everyone, that's all the time we have for today. We hope you enjoyed this deep dive into the top financial headlines.
And remember, the world of finance is constantly changing, but by staying informed and thinking critically, you can position yourself for success.
We'll see you all tomorrow morning with new headlines from major financial magazines. Until then, happy investing.